Hello friends, this income tax course is mainly meant for the intermediate course of CA, CMA and CS. The same can be used for any other course where income tax is a subject for them. Here, the assessment year we are considering is 25-26. That means the previous year is 24-25. Now, the Income Tax Act is divided into different chapters, or there are different heads are there under which the incomes are charged by. So there is salary head and house property, PGBP, capital gain and income from other sources. And PGBP is the lengthiest of all. For the ease of teaching, it is subdivided in different parts. Here we are considering the part 1 of PGBP, which is income from business and profession. Now, let us first see what's the business and what's the profession. Any trade, commerce or manufacture or any adventure or concern in the nature of trade, commerce or manufacture is a business. Generally, business means recurring economic activity. But for income tax purpose, an isolated activity may also be considered as a business. Any business activity which is economic in nature with the objective of earning profit is a business. We call some activity an adventure when we are doing it for the first time without knowing its outcome. Section 213 of Income Tax Act defines the business. But profession is not defined in the Income Tax Act. Section 236 says profession includes vocation as well. Now, when we say profession, even though profession includes vocation, profession requires purely intellectual skill or manual skill on the basis of some special learning and qualification gathered through past training or experience. Example, a chartered accountant, doctor, lawyer, etc. Professional skill can be acquired only after systematic study, maybe in a college or an institute, and we can apply the knowledge acquired in the practical applications. Vocation is the natural ability of a person to do some particular work, maybe singing, dancing, etc. The term vocation is different from the term hobby. Vocation must have the earning feature. So, unlike profession, vocation does not require a degree or special learning. Now let us see what is meant by profit. Profit can be in cash or in kind. When we say in kind means it is not in cash. Profit is realized in any form other than cash. Then cash equivalent of the same on the date of receipt must be taken as the value of the income received in the kind. If you receive a mobile phone as kind, then the equivalent fair market value shall be accorded as income. Capital receipts. PGBP head deals with the revenue receipts only, and capital receipts are dealt separately in the capital gain head. When you consider the profit and loss account, we have the income part and we have the expenses part. in the expenses, all allowable expenses under income tax are considered, then from income and expenses we can derive the profit. Voluntary receipts. Voluntary payment received in the course of business or profession shall be treated as income in the hands of the recipient. For some voluntary receipt to be considered as income, there should be a clear nexus or connection between the business and the payment received. For example, a lawyer receives some gift, additional gift, other than the professional fee received by him from the client, say for winning a difficult case. So the fair market value of that gift is also to be added to his professional income, business income. Application of the gain, profit or business profession is immaterial. So you may get a business income, but for what purpose you are using that profit or that income is immaterial. You may use it for some philanthropy purpose, maybe for some good cause or for the benefit of the community. So whatever be the application of the income you receive, if you earn income from business or profession, you are liable to pay tax for that. Legality of the income. So it is immaterial whether you earn the profit from legal or illegal business. However, such unlawful incomes are not allowed for deduction while computing profits of such businesses. Income from distinct businesses. An assessee might have multiple businesses. He may have cosmetic businesses, then he may have textile businesses or fast moving consumer goods businesses. Even though the profits are calculated separately, the tax should be calculated on aggregate profit. Computation of profits. Profit should be computed after deducting the losses and expenses incurred for earning income in the regular course of business, profession or vocation, unless the loss or expense is expressly or by necessary implication disallowed by the Act. That means all allowable expenses can be deducted from the income to arrive the profit. The tax levied not on the gross receipt but on the profit and gains. For the purpose of income tax, whether you are having a business or profession or vocation, profit from all the sources are treated on similar grounds. Now, for any head, the most important or the first section we are considering is the chargeability section. Income chargeable under the head PGBP is detailed under section 28 and part of section 41. So under section 28, clause 1 to 7 gives the various incomes to be charged under income tax. So section 28(1) says profit and gains from any business or profession carried at any time during the relevant previous year is chargeable under PGBP. So if you are having some income from residential properties, that will be charged under house property and not under PGBP. Even though you are having the business of letting out houses, that income is chargeable under HP, house property, and not under PGBP. When we say income from business profession, we have to consider income from speculative transactions also. The speculative transactions we will discuss in detail in the next sections. Section 28.2. Any compensation or the payment due or to be received by any person managing the affairs of an Indian company or by any person managing the affairs of any company in India when it is terminated or modified the terms and conditions of the agency's appointment, then if they receive some compensation out of this, that income is chargeable under PGBP. Any compensation received by a person holding an agency in connection with the termination of the agency or the modification of any terms and conditions relating thereto is chargeable under PGBP. Similarly, any compensation received or receivable in connection with the modification of terms and conditions of a contract is also chargeable under this head. For example, ABC Limited gives some contract to a supplier for raw material for 1 crore, and as per the contract conditions, actually if they are not supplying or if they are delaying the supply by 1 month, there will be compensation of 0.5%. If they delayed by 2 months, there will be compensation of 1%, that is 1 lakh, if the supply is for 1 crore. But unless otherwise there is a modification in the contract, then it is not chargeable under PGBP. And if they are getting a compensation after modification of the contract, then only it is chargeable under PGBP. Section 28.3. Income from specific services performed to its members by a trade, profession or business association. Here there are different associations, trade associations are there. But actually, if the membership fee is collected from the members and it is used for their own purpose, it is not an income and it is not chargeable under PGBP. For example, a housing society. There are different members in the housing society, and from the members they are collecting a fee for the common facilities, and in 1 month they collected 50,000 rupees and used 35,000 only, and 15,000 balance is left. That amount 15,000 is not a profit. Okay. It is based on the principle of mutuality and it is not taxable. It is not considered as a deficit or profit, a loss or profit. But you consider a market survey conducted by FICCI, the Federation of Indian Chamber of Commerce and Industry. If they give some market survey, some service of market survey for one of his members for an amount of 60 lakhs, when they deduct their expenses of 45 lakhs, for example, then if they get a profit of 15 lakhs, that is chargeable under PGBP. That is for a specific services for a specific member. It is not a common cause of all the members, not for the common cause of all members. Now, Section 28, 3A, 3B, 3C. An export incentive in the form of import entitlement license, duty drawback, duty-free replenishment certificate, all are taxable if they get an income out of this. Import entitlement license is a permission to import some restricted items to a certain percentage of the export. And this certificate is, this license is transferable. No money is credited here. You will get a certificate to this effect. And the sale proceeds of this import entitlement license is 100% taxable under PGBP. There is a duty drawback or DEPB, duty entitlement passbook is there. So that duty drawback scheme aims to provide the refund or recoupment of customs and excise duties paid on inputs or raw material and service tax paid on the input services used in manufactured export goods. When you are exporting some goods, you may be using some raw material for the manufacture of the exported goods, and whatever duty you paid, excise or customs duties, that will be refunded, recouped to their bank account or to duty entitlement account, DEPB, duty entitlement passbook. It's a separate account, there it will be transferred. So different rates for duty drawbacks are there for each industry. These are fixed by the government after every budget through all industry rates. For example, for car manufacturing industry, the rate is 20%. The profit on transfer of duty entitlement passbook is actually the difference between the sale proceeds and the amount available in the DEPB account. Okay, so the difference amount is taxable under PGBP. Then there is a duty-free replenishment certificate. So in duty-free replenishment certificate, actually there is, if you are using some imported goods for the manufacturing of exported goods, then for some certain percentage of the export, you will get, you can import the input that used for manufacturing the export product duty free. So maybe 10% is the rate of duty free replenishment certificate, and you are exporting 1 crore, up to 10 lakh you can import items duty free for the manufacture of the exported items. Export incentives received or receivable to exporters is PGBP income. These are all called EXIM scheme. This is mainly the government is giving such kind of incentives to encourage the export. Under this EXIM scheme, exporters can get import duty concessions to a fixed percentage of their export value, which is transferable. Now, the foreign trade policy is formulated every 5 years, and now the latest FTP is from 23 to 28. 2023 to 28. Now, cash assistance received or receivable by an exporter under the Government of India scheme is also chargeable under PGBP. Now the duty drawbacks rights are either a percentage of the free on board value of the exported goods, or represent the rate on a per unit basis. Thus, if your FOB value is 10 lakhs and your drawback is 10%, you will have 1 lakh payable. FOB stands for free on board. It is an international shipping term used this way when the seller's responsibility for goods ends and the buyer takes out. The seller is responsible for all costs after the named port of shipment. The buyer is responsible for all costs after the good passed the ship's rail at the named port of shipment. So the seller is responsible only up to the shipment point. Once it is shipped, it is the responsibility of the buyer. So duty drawback can be received in the bank account or in the duty entitlement passbook. Both ways it is taxable under PGBP. So the exports incentives available to exporters are profit on sale of import entitlement license. The whole sale proceeds is taxable. Cash is received by a person against exports. Then duty drawbacks, 100% taxable, then credited to bank account or DAP. Profit and transfer duty entitlement passbook scheme is the difference between sale proceeds and the amount available at the DAPV. See that the profit on transfer of duty free replenishment certificate is 100% sale value is taxable under PGBP. The duty free replenishment certificate is issued to an exporter or manufacturer for the duty free import of inputs such as raw materials, component, intermediates, consumables, spare parts, etc. to be used for the export or production. Now section 28(4). It says value of any benefit perquisite from business or from excess of profession in cash or in kind fully or partly taxable under PGBP. For example, there is a TV dealer and his target given is 10 lakhs per month. And if he achieves this target, he will get a free trip to Switzerland for 2 lakhs. Now, the worth of the trip, 2 lakhs, is chargeable under PGBP as far as the TV dealer is concerned. In the hands of the dealer, this amount is taxable. Section 28(5). Sum or remuneration due to or received by a partner of a firm. Now, in a partnership firm, any remuneration received by the partner except LLP are taxable under PGBP in the hands of the partner to the extent allowed in the hands of the firm under section 40B. That means 40B, section 40B limits the amount that can be transferred to the partners as remuneration, interest, commission, bonus, etc. The maximum interest that can be paid to a partner for his investment is only 12%. And if more interest is paid, whatever percentage given above, for example, if 15% is paid, the 3% is taxable for the firm. The partner is responsible for only 12%, and for him it's the PGBP income for the partner. 12% if you are getting, he is responsible for 12% under PGBP, that is considered as a income, and he has to pay tax for that. But the share what is getting, profit share what is getting is not taxable, because the profit share is given from the taxable profit of the company. Already company is paying tax for the profit. 40B, there is a maximum permissible limit for remuneration. So if you have income up to 1.5 lakhs, you can pay maximum 1.5 lakh to the partners. If it is between 1.5 to 3 lakhs, 90% of the book profit can be given up to 3 lakhs. And above 3 lakhs, only 60% can be given to the partners. And the maximum percentage of interest is only 12%. 40B limit the salary and interest to partners, then by removing the possibility of sharing the whole income of the firm to partners. They will not paying any tax by the firm. For example, if you have 21 lakhs profit, there are 3 partners, it can be equally divided between the 3 partners, 7 lakh each. That means actually there is no tax for the firm. So this is prevented by limiting the remuneration that can be paid to the partners. They can give actually 7 lakhs as salary to the 3 partners, and 7 lakhs when 21 lakhs is completed, and there is no tax for the firm since it's given as salary. Because up to 7 lakh is not taxable for this financial year. As per section 10(2)(a), a partner share in the total income of the firm is exempted from tax. The partner share is divided in the profit sharing ratio based upon the investment of the partner. Section 40B we will study in detail in the later sessions. So I am not going to elaborate it here actually, because then it will be repetition when we learn it in the other sessions. As I mentioned, the book profits, if you are saying if the book profit is negative loss or maybe up to 1.5 lakhs, maximum amount deductible in respect to remuneration to partners under section 40B is 1.5 lakhs. And if it is up to the first 3 lakhs, that means between 1.5 to 3 lakhs, 90% of the book profit, whichever is higher, can be given. On the balance, 60% of the book profit can be given. I mean, if it is 10 lakhs up to 3 lakhs, you can give 90%, and the balance 7 lakhs, 60% can be given to the partners. So any remuneration above this limit is not allowed as deduction in the hands of the firm, and also not taxable in the hands of the partner. Here we can see the salary, commission, etc. are PGBP income for the partner, and the share on profit is exempted. Interest on capital is a PGBP income for the partner. Section 28(5)(a), non-compete fee. Any sum received or receivable in cash or in kind or an agreement. Now this non-compete fee is given for not carrying out an activity in relation to a business or profession, or it can be for not sharing any know-how, patent, copyright, trademark, license, franchise, or any other business or commercial rights, information, technique likely to assist in the manufacturing, processing of goods or provisions for services. There are of course exceptions. If you receive some amount in cash or kind for transfer of right to manufacture or produce, you are getting it for transferring. The other one is non-compete fee is getting for not transferring. For transferring you are getting some amount, then it is under capital gains, chargeable under capital gains. Any compensation received on the Montreal Protocol on substances that deplete the ozone layer is not chargeable under PGBP. That means actually maybe the under Montreal Protocol, maybe some, for example, in the refrigeration industry, the freon gases are not to be used. That is restricted. For that, actually, if you are getting some compensation, then that compensation is not a PGBP income. Now, section 28(6), key man insurance policy. In any industry, there will be some key persons, and these key persons are running the business, and if they leave the business will be in big trouble. So the employer can take key man insurance policy on these employees. Okay, any sum received under key man insurance policy as an employer, including bonus, is taxable under PGBP. As per section 10(10)(d), key man insurance policy is a life insurance policy taken by a person on another who is or who was an employee of the first mentioned person or the employer in some manner connected with the business of the first mentioned person. The key man insurance policy, if the bonus received by the employer is PGBP income, and if it is received by the employee, it is considered under salary head, and if on the demise of the employee, if it is given to the legal heirs, it is income from other sources. A key man in a company refers to any employee who is considered crucial to the smooth operation of the business, meaning their absence or disability could significantly impact the company's profitability or functionality due to their unique skills, expertise, or critical role in key operations. Essentially, they are considered indispensable to the company's success. That means these persons are very much important to the company, and and actually their involvement is very crucial to the success of the business. That's why they are insured. Section 28(6)(a), conversion of stock or inventory into capital asset, conversion and the treatment of that. So when it is converted, the fair market value to be taken as business income or at the date of conversion to capital asset, and it is chargeable under PGBP income. For example, an AC and air conditioner seller, and AC is an inventory for him, and if he take two of that air conditioner for his office from the inventory, then that will be converted into PGBP income, because there is a difference in opening stock and closing stock of the inventory, and that will be reflected in the as loss in the P&L. This will be compensated by treating those inventories converted to assets as income in P&L account, so that the impact on profit will be nil. Now, you can consider another case, maybe some builder. Builder is actually taking one of the houses as his office. Then also it is the similar case, because as far as the builder is concerned, the houses are his inventory. When he is taking for his own use, that will be converted into capital asset and is chargeable under PGBP. Section 28(7). This says that if you receive some amount on account of the capital assets being transferred, demolished, destroyed, which are already deducted from the income, means the 100% deduction is received under 35(a)(d) specified businesses, and if you get some income out of transferring of such assets for which 100% deduction is claimed, for those sum tax is to be paid under PGBP. In normal businesses, only depreciation on capital assets is deductible under profit and loss account. But for specific businesses, under 35 AD, 100% reduction is given. We will learn in detail what is specific businesses. Specific businesses are some businesses the government wanted to promote. For that, they are giving, to promote such businesses, they are giving maintained 100% reductions. For example, a gas pipeline. It's a very huge capital intensive business. So actually nobody will come forward for that. And for that, so since it is a gas pipeline is very much required, government is giving a 100% reduction for the capital investment as well as the revenue investment, both. They're giving. So already the reduction is claimed. Then if you are selling those assets for which already reduction claimed, and if you are getting some amount out of that, that amount is chargeable under PGBP. Now there is an explanation too of the chargeable section 28. That is, the explanation is regarding speculative business. Income from speculative business. Now income from speculation business is charged under PGBP, but that business must be deemed as distinct and separate from other businesses. Speculative transaction is a transaction in which a contract for the purchase of sale of any commodity, including stocks and shares, is settled otherwise than by actual delivery of or transfer of the commodity or goods. So there are two types of transaction. There is intraday transaction and intraday transaction in stock exchanges. So when there is intraday transactions, the shares are not actually sold or purchased. So because we are using DMAT account for such transactions, at the end of the day, that means from the transactions are carried out from 9:15 a.m. to 3:30 p.m. Okay, 3:30 p.m. And at the end of the day, that is 3:30, after 3:30 p.m. only, that net shares are calculated, and if there is no change in that, actually it will not be considered as a sale. So within a day, there is a speculative income is created. That income will be chargeable under PGBP. If it is more than one day, it is intraday transaction, that will go to capital gain. Here actually only speculative transactions of shares are considered as PGBP income. It does not cover transaction in respect to trading on derivatives or commodity derivatives. Also, it does not cover transaction by a company, the principal business of which is the business of trading in shares or banking. For a company which is in the business of trading of shares, the income is PGBP income. But both cases it is PGBP income, but actually speculative transaction you have to consider separately. Why? Because actually the losses of the speculation business can be carried forward or set off by the income from gain or profit from other speculative businesses. You cannot set off with the other businesses other than speculation businesses. Therefore, speculative businesses has to be considered separately. The loss of speculative business carried forward to a subsequent year can set off only against the profit or gains of any speculation business in the subsequent year, and hence must be treated separately. This deeming provision does not apply to a company whose gross total income is mainly from heads, interest and securities, income from house property, capital gain or income from other sources. A company mainly engaged in the business of trading in shares, banking or granting loans and advances, this is not applicable, because for them it is not a speculative business, it is the main business income. If the companies carry out buying and selling of shares of other companies, it is not considered as speculative business. Exceptions: not speculative transaction, hedging contracts in respect of raw materials or merchandise for manufacturing or merchandise business to guard against price fluctuations affect this contract. The hedging of raw material or maybe metals. For example, there is a cable manufacturing company, and the cable manufacturing company, they are using copper conductor in the cables, and the copper prices is fluctuating, and because of that, to safeguard against the fluctuation of the copper, they are hedging it. Maybe for they are actually fixing, they are hedging it for 2 months. Maybe after 2 months, they are fixing the price. They are saying, okay, I will buy the copper at this price after 2 months. That is hedging. So this is they have done to safeguard against the fluctuations. So at a fixed price, that price they will get it. In case there is a difference, they have to pay the difference. So such kind of hedging for safeguard against fluctuations is not considered as speculation business. Hedging contracts in respect of stock and shares to safeguard against the loss of holding of stocks and shares from price fluctuations. It is also not considered speculation business. Forward contract entered by member of forward market or stock exchange, trading in derivatives in a recognized stock exchange, trading in commodity derivatives carried out in recognized stock exchange is chargeable to commodities transaction tax under Chapter 7 of Finance Act 2013. Now for trading of commodity derivatives, there is a tax is there. There is actually commodity transaction tax. This is very small tax has to be paid, and this is actually is chargeable under PGBP. Trading of commodity derivatives, if you are getting some income after that you will just be charged under PGBP. Transaction of a company whose main business is trading in shares or banking, it is not considered as a speculation business. But the interest is the PGBP income. Now you can see the stock market, there is equity stock and commodity stock is there. Equity there, that's intraday trading is there. The spot market intraday, that is the speculation business is there. It will be charged under PGBP. Intraday, after 1 day it is being dissolved. After buying, you keep it for 1 day and you are selling it, then it is actually, as far as trader is concerned, for him it is a inventory and it is a PGBP income for him. As far as investor is concerned, it is a capital gain for him. But there is actually that a future and options derivative market is there, F&O market, and it will be PGBP income for the F&O market. And if you consider the commodity market, there is agricultural commodity and non-agricultural commodities there. For example, metal derivatives, there will be PGBP income for non-agricultural market, and for agricultural market, that is speculation income. Now you can see the share investment for investor. Sale of a share is if you're getting some income out of it is a capital gain for the investor, and dividend is income from other sources. And for inventory, it will be sale will be PGBP income, and the dividend is income from other sources. And for securities and debenture bonds, investment for investor, sale is actually capital gain and interest is income from other sources. Stock in trade, sale is capital gain and interest is income from other sources. Interest is income from other sources. Now, trading in shares are done through demat accounts of NSDL or CDSL. CDSL is Central Depository Service India Limited, and NSDL is National Securities Deposit Limited. These are the subsidiary of National Stock Exchange. Okay. This help the investors, financial institutions and government agencies to buy, sell and store financial securities electronically. Now the security transaction tax is applicable on trading of securities. Intra-day trading income without actually selling or buying is speculation income. Normally the trading happens between 9:15 a.m. and 15:30 or 3:30 p.m. It's from Monday to Friday it's happening. The shares will be reflected in the demat account after the closing hours. In case there is a difference in shares at the end of the day, it will be reflected in the demat account. You can sell shares even when you don't have the same in your demat account and buy at a lower rate within the same day without having the demat account, thereby making speculative income. And this income is chargeable under PGBP. Now we have covered all the sections under 28, under section 28, the chargeable section, and some other sections are there. There are which are deemed profit, and the treatment are there under section 41, which we will consider in the next session. Thank you.